Hey all, I sat down in London last week in person with Josh Saul, and I asked a few of my financial world buddies to give me some questions for Josh because Josh is the CEO of Pure Gold UK. And we ran through a lot of stuff that you really should understand about the current world of macroeconomics and, of course, precious metals as a crucial element for you and your family to keep a portion of your pension or any funds safe from what's going on. So the link is down below, by the way, to Pure Gold UK. My followers get a free consultation and some free storage if you wish to explore that. But anyway, let's get to Josh straight away. I'm here in London, beautiful weather, and I've met up again with Josh Saul. Great to see you, Josh.
Good to see you, Ivor.
Absolutely. And Josh is an absolute expert, not just on precious metals, but on everything financial and macroeconomic. As you're the CEO, I guess, or the managing director of Pure Gold London.
That's right.
Excellent. Well, you know what? I usually don't have notes, but because I'm in situ now with you, I actually threw down a bunch of questions and I'm going to actually follow a script, which is very unusual for me. I want to cover everything. So, firstly, a brief history on how physical gold has proven itself beyond all other assets, essentially, particularly over the last decade or two, but even back into the past.
Well, that's a good question. It's a broad question. You know, physical gold has been around for centuries, right? It predates currency as we know it. It predates banknotes. It predates bank accounts, equities, bonds, any sort of financial instrument. It was the currency of choice thousands of years ago, where we were, exchanging money for services. That's if you didn't have a service to barter with. And so the benefits of physical gold have actually maintained itself over the centuries in which people have used it. First of all, it's private, it's physical, it's tangible. You can't just print it like you can with cash. You can't just create more gold. It's very, very difficult. And it has an inherent store of wealth, right? People have become trusting of the fact that an ounce of gold, short of it being stolen by someone, you're going to wake up in the morning, it's still going to be an ounce of gold, right? There's no counterparty risk. You're not having to rely on a third party. You're not having to rely on a third party providing you with access to your gold, which can't be said for cash or equities or bonds or any other financial instrument. And so physical gold has been used throughout centuries. We then had the introduction of fiat currency, and even fiat currency was backed by physical gold in what we once called the gold standard, which was removed in the 1970s. And effectively, as JP Morgan says it, physical gold is money and everything else is credit, right? And that couldn't be truer than it is today. So if we talk about the fact that, physical gold, it's motivated by investors for a variety of reasons. The first of which is the general market. What's the market doing? Where are the risks? Where are the uncertainties? Can we predict them or can we anticipate them? And that's an interesting question or statement, because there are certain things you can predict within reason, right? We know that markets are cyclical. We know that every 7 to 10 years, equities should correct. It's just the way of the world. We know that bonds will increase in yield, they'll decrease in yield. We know that recessions happen periodically. We also know that interest rates go up and go down, right? And so within reason, you can predict that these things are likely to happen. What you can't predict are the black swan events, the COVIDs, the Brexits, the likes of, presidents becoming power hungry and volatile and creating trade wars and trade impositions that affect the free market economy. These sorts of things you cannot provide for. But as time has taught us over the last 10 years, we can anticipate. We're growing to anticipate the fact that every 18 to 24 months or so, something happens that you couldn't have expected. And so you've got market forces at hand. The second is, if we're not accepting that physical gold is purely a store of wealth and a means of preserving your capital, preserving your wealth, then one has to accept what are your viable options. When there's a lack of viable alternatives within the market, then gold, physical gold, stands out as an obvious choice, either as an alternative or as a means of being able to balance and diversify your portfolio. What's really interesting, actually, is that physical gold has always maintained its wealth consistently. You know, if we go back to biblical times, an ounce of gold would have bought you a loaf of bread, right? I think you could probably get a little bit more than a loaf of bread these days with an ounce. But the point is, it's more than maintained its wealth. Whereas, you know, if we look at fiat currency, you know, since the 1970s, we can see that sterling has lost more than 98% of its purchasing power. And so some people say that gold has increased by 11,000% since the 70s. Others would say, well, that's not completely accurate. It's that gold has maintained its purchasing power, possibly more so, and anything on top is a bonus and is growth.
Yeah, absolutely. And I think there's a finely tailored suit as well. You can buy now the same amount of gold or then some. And I heard one, Josh, you can buy 4 houses of a certain large size in America using gold, where you could buy one, I think, in the 70s. Like, so that's 4x. So even better than holding value. Yeah, absolutely. Now, it does bring me quickly on to another one that got me super interested in gold, and I moved family pension and everything into physical, obviously not ETFs. The BIS, when I learned that the Bank of International Settlements, the head of all the central banks, moved gold from, I think, 2B or something, well down, right up to tier 1, and the only other tier 1 asset is US sovereign debt, the dollar. It sat on its own. And gold in 2019 shot all the way up. When I saw that and then realized from other people in the network that the central banks were amassing hugely, and still are, I believe, over the last few years, and I think this year even more than last year, that for me is a no-brainer. You've got your answer on moving a large chunk of your family wealth into gold. What do you reckon?
Well, it's certainly a message that the financial institutions, including, you know, the FCA, are conveying to the general public. You know, regardless of what they're telling the general public to do, they clearly regard physical gold as liquid as cash. But I think if we go back a few steps and ask ourselves why do banks have a capital adequacy ratio? You know, why do banks have to have enough cash on their balance sheet? And I think, first of all, some of the biggest runs that we've seen on banks have purely been because there hasn't been enough money on account to satisfy the amount of people that deposited that money there in the first place. And so for every £1 that we give our bank, they create £6 worth of debt, right? And so, you know, banks aren't charities, they need to make money, and the way in which they make money is they rely on us giving them our money. Right? And actually, as soon as we give our money to the bank, whilst they owe us that money, the money we've given them isn't ours anymore. Right? We've given them something we own, and they now owe us something. And the issue comes from, you know, if there's a huge level of uncertainty, fear, panic within the market, it might be rational, it might be irrational, it might be contagious, right? A lot of these things usually are, right? It starts with one small thing and it starts to spread. And regardless as to whether or not the fundamentals of that fear are correct or not, it's the sentiment. Perception is very much reality. And so if a bank doesn't have, however profitable a bank might be, if they haven't got enough liquid cash on their balance sheet to satisfy depositors that want their money back, well, that then creates panic for other depositors who aren't even thinking about trying to get their money out. that's when you start to see the proverbial queue, in this day and age, probably a virtual queue of people desperately trying to access the money they've got in their bank account. And so banks were never really well capitalized. The more a bank has to be capitalized, the less opportunity it has to lend that money out to make money, right? And so it's a conflict. The banks want to be, the banks want as little capital as possible tied up within the bank. The regulators want as much of it, tied up within the bank. And so the question that is then raised is there a way of being able to remove or mitigate the downside of holding cash or US dollars? And so given that physical gold is instantly capable of being liquidated very, very quickly, given that there's a global and open market for being able to buy and sell it between institutions, countries, sovereign wealth funds, yes, gold was moved up to tier 1, which meant that not only could the banks remove exposure to a volatile dollar, but it could also put itself into a better position whilst capitalizing itself and adhering with the regulators' requirements in terms of having enough liquid assets or enough liquid cash on its balance sheet.
Yeah, no, excellent. And I think it was Buffett or one of maybe his Charlie Munger said it's a barbarous relic and it's, something of yesteryear. It's kind of ironic. It's become the exact opposite because the whole system now has gone back to it in a massive way. But I think that's very reassuring for people as well who are thinking of owning some. If all the huge boys are amassing, what's the chances that they're incorrect, to be quite honest? Recent hockey stick, I use the term from the climate kind of change thing, but it is kind of a hockey stick price rise, and it's taken some people by surprise. And it seems to be driven by, yet again, big players, big boys, institutions, private wealth funds. Retail, I've heard, is not getting in, like ordinary people, shall we say, middle class. That's, I gather, what's driven up the price. And it seems to me, since I learned a lot about gold in the last few years, off yourself and many others, the system doesn't seem to really want ordinary people to be getting in. What's your thoughts on that? It's not really a conspiracy, but there seems to be a disinclination to have little people get in there and hedge and keep their families' money safe.
Well, your assessment isn't wrong, but it's relative, right? And so we know that the various counterparties that purchase physical gold, you've got central banks, you've got family offices, institutions like family offices and hedge funds, then you've got banks, then you've got other institutions that aren't necessarily financially orientated, then you've got individuals that might be provided access to the gold market by way of an ETF, and then you've got physical, right? And so you've got the subdivision of counterparties and stakeholders that purchase physical gold. In 2021, we saw 1,146 tons of physical gold purchased, which was a record. We've got 35,000 tons that are held globally by central banks around the world. And so purchasing by central banks is at an all-time high. We've never seen we've never seen central banks binge on physical gold in the way in which they have over the last 5 to 10 years. Most prevalently over the last 2 to 3 years. The question is why? And I think, a lot of central banks are very concerned with the fact that, currency is volatile. It's not as safe as it used to be. They don't want to be holding on to the US dollar. They also realize that, the US dollar can be weaponized by various countries, including the United States. When they saw that, Russia was sanctioned, whether or not that's right or wrong, that's not the question we're getting into. But the fact that it happened gave a lot of countries cause for concern and thinking, well, what's to stop another country deciding to sanction our currency? And would we be better off with more of our wealth in physical gold than sitting in cash that might then become redundant because countries have sanctioned it? So there's been a huge drive for physical gold as a result of that. through central banks. Hedge funds and investment banks, again, institutional players, demand has been huge. A lot of the investment banks that hold gold to, first of all, comply with capital adequacy, tier 1 ratios, and second of all, within their own self-interest, to remove exposure to other asset classes that might well erode, a fund's performance. Investment banks are there to make money, right? And so investment banks will make a lot more money from selling structured products, currency, equities, bonds, debt. They will make more money selling those securities and those products than they will do with physical gold, right? Because with physical gold, it's a lot more transparent. You can see, if an ounce of gold is X, then you know exactly how much you should be getting. Within reason, right? Coming back to your question in terms of, what are we seeing in the retail market? If we're talking about ETFs, back in 2011, which is kind of mid credit crunch, where we saw, Lehman Brothers and Northern Rock collapse. Back then, we saw around 8% of ETF holders or ETFs were backed by physical gold. Today, it's less than 2%. So there is 100% a huge underexposure to physical gold electronically. Now that may well be because, clients aren't being informed. It also may well be that clients have decided to move away from digital products, right? To have something that's physical, to have something that's tangible, something that sits in your hand, something that sits outside the banking system. What I know is that, we service retail customers, from all walks of life, doctors, lawyers, bricklayers, NHS staff, teachers, people that are completely retired. And we've seen a monumental increase in people purchasing gold and silver bars and coins. We've also seen an incredible increase in people removing exposure to equities and bonds within their pension to purchase physical gold within the same vehicle. And it was even, I think, the Royal Mint that said that they saw a 350% increase in their first quarter 2025 results. And so, relatively, you're completely correct. You're right. The big moves we see that come from the big players within the market. But what I would say is we're seeing a huge shift from people exposing themselves to gold via an ETF to people deciding to purchase physical gold and hold it in its tangible form.
Yeah, which again, well, we all believe is crucial, of course. And just for people not too familiar, exchange traded fund, ETFs usually just get a whole bundle of stocks, put them together so you can just buy one thing. But in the case of gold, it's basically paper gold. And 2% is backed by physical gold when people buy these instruments. So it's kind of crazy. The most consistent thing I've heard, Josh, in my 4 or 5 years being involved in this sphere is don't touch paper. I mean, it's so consistent from Rick Rule to Piepenburg to everyone. It's all about physical.
I think, well, if you're motivated by safety and security and wealth preservation, my opinion is that you're undermining those objectives if you're going for something that creates a shortcut that might well be a little bit cheaper, but it doesn't provide you with the necessary safeguards that physical gold provides.
Yeah, actually, the way I would possibly look at it as well is if you're more in speculation, it's easy to hop in and out of the ETF, but that's not what we're talking about. I think generally physical gold is about securing, maintaining the value of your wealth, such as it is, over time, but there's also an investment aspect. So securing your wealth and not losing your money like the melting ice cube of fiat money is fantastic, it's crucial. But also increase in value even beyond that, investment. What do you think of investing and kind of speculating on growth as opposed to just securing?
Well, it's an interesting question because when we have people that inquire with our company, we've got people that are worried about government control, worried about banks. We've got people that want a diversified portfolio. They hold equities, they hold bond, they hold a little bit of cash, property, and they want some gold within their portfolio to hedge the possibility of those other asset classes falling in value. And then you've got people that see that gold's increased by 40% over the last 12 months, that gold's increased by 11% year to date, and they want a little bit of that, right? They might have heard that JP Morgan have revised its predictions for physical gold, and they believe that it's going to hit 5,000. I believe they've just amended it to $6,000 per ounce. At the time of hearing this podcast or video, that may well be different because they're amending it all the time. But it is human nature to want a part of that. I think what's driving that? Well, I think inflation, whether or not we choose to believe what the government are telling us in terms of the inflation rate, let's call it 4%, right? I don't believe it's 4%, but let's call that 4%.
Hey guys, hope you're learning a lot. Just a brief interlude here to remind you the link is down below directly to Pure Gold UK, and they have a whole team of advisors highly educated on this whole arena and more, and you get a free consultation with no obligation, but I would recommend exploring this area further. And the last thing I'll say before we cut to Josh, even since I sat down with him, silver is much higher in my mind now, physical silver, because just in the past few days, it's broken out after a 13-year kind of flat period. Probably price fixing was going on that's now beginning to slip. So silver could have a lot more potential in the next year or two relative to gold, but both are precious. And with that, back to Josh.
We know that they changed the metric in which they assess inflation, right? Back in the 80s, 90s, from RPI to CPI, right? And what that did was it changed the weighting of the products that everyday people purchase. And what that meant was that they were able to control inflation, so they weren't exposed to having to increase social security or increase people's pensions and create an increase in liability on the government, right? It was one way in which they could control and manipulate, our assessment of how much things are increasing. I guess my question is that when you go to a restaurant, when you go to a grocery store, when you walk into a shop, it doesn't feel like 4%. Forget the science and the kind of putting things into a shopping basket. Things feel a lot more expensive than 4%. I think it's because they are, right? A lot of things are, either the things in shops have become smaller and they've maintained the same price, which is deceiving at best, or, certain things in restaurants that aren't in that kind of hypothetical shopping basket that's used to measure inflation, right, are 60% more expensive. And so there's an economist called John Williams. I don't know if you've heard of him, but John Williams, he decided to assess inflation based on the government's old model of inflation, right? And this is for US. And the figure he came to was 12%, right? Which I would say is probably more accurate than the 4% the government lead us to believe. And so if we accept that inflation is 12%, and we know that if we look at the alternatives, keeping money in a bank account, you're not going to get more than 3.5% to 4%, right? Bonds, right? Again, you're not going to get more than 3.5% to 4%, right? So those two asset classes are a guaranteed loss to purchasing power. The next alternative is, well, what about equities, right? Equities are a good way of achieving compounded growth over the long term. They are, right? It's undeniable. However, I think equities are going to struggle to keep up with inflation over the short term and over the midterm. I actually think that equities may well compound the problem. And this is why. If you look at the performance of the S&P 500 since 2015, we can see a 500% increase in the value of the index. And so we know that the index comprises of a collection of companies, the S&P 500, 500 companies. That wouldn't be a problem if we saw the profits of those individual companies increase by the same level, right? The converse is true. The profits have only increased marginally relative to the increase in the share price of all of those companies. And what we've seen is two reasons. There's been two motivating factors that have created that situation. The first of which is the creation of money, right? We've seen a huge increase in money supply, which has then, gone into purchasing equities, which has increased the value of those equities. You've then got corporate buybacks, right? Which is companies buying back their own shares for higher prices, which then give the perception that they're worth more. I'm not going to bore you or the audience into that school of thought, but those I would say are the two main reasons. But here's the crux of it. You've got a mechanism that's used to value equities called the price to earnings ratio, right? So it's the price of an equity versus the earnings that company might generate per share. Historically, or shall I say at the moment, the S&P 500 sits at around 34.5, which means that it takes 34.5 earnings to create the value of that equity. The historical average is around 17.5, right? Which means that if you're buying equities for less than 17.5 price to earnings, you're probably getting a good deal. If you're buying at 17.5, it's probably market. And if you're paying anywhere over that, you're probably paying too much, depending on where we believe the value of the index to go. So if we look back over the entire history of equities, and I mean if we go back all the way to the 1800s, we've only ever seen price to earnings go beyond where we are right now on 4 occasions. The first was 1929, Black Tuesday. The second was the dot-com bust, right? We saw the NASDAQ drop more than 75%. We saw the S&P 500 drop 50%. The next was 2008, credit crunch. Again, we saw equities fall, we saw gold increase. The fourth is today, right? And right now we're sitting at a point in which price to earnings have never in their entire history been at the level they are today without the equity market crashing, right?
And that'd be like most of the best people out there are throwing around a 30 to potentially 50% correction at some point. But how are you going to call it? And some people are still in, and there may be a final kind of crazy melt up before that happens. But as David Webb said to me when I asked him this, he said, Ivor, you don't want to be picking up pennies in front of a steamroller. It's very risky to be in now because, what do you think? The next 6-12 months, God knows what will happen. I mean, will it teeter up and then just roll over in a spectacle? What?
It's a really hard one. There's just so much volatility within the market. One day you're looking at a 9% drop. The next day you're looking at a 6% recovery. It doesn't help that we've got politics that are the most volatile we've seen in a long, long time. But I think we take our cue from the smart money, and if we look at the institutions, are they playing the same game as the typical average investor? 2 steps forward, 1.5 step back. They're not. The way in which they operate, if you look at a graph, there's a graph called the Smart Money Flow Index. I'll send it to you so you can show your audience. What it captures is institutional wealth being drained out of the market. It won't pick up, me or you purchasing gold. It will only pick up the very large institutions. And so what it tracks is the flow of money out of the equity market. And if you layer the performance of the S&P 500 what you'll see is a graph that goes like this. And then if you add on the smart money flow index, what you'll see is a line going like that, which shows you money being drained out of the system, but it's being drained out of the system lower than the growth in which the S&P 500 is achieving, right? Some people would say they're leaving money on the table. But institutions are thinking big picture, right? Once they start to see fundamentals that support downside risk in favor of upside longer term gain, and that's kind of coupled with other asset classes that tend to do very well in times of uncertainty, then it's quite immaculate, the trend of smart money flowing out of the equity market and into an asset class such as physical gold. We've seen Ray Dalio comment very recently about his purchase and his exposure to physical gold. We've seen the likes of Michael Berry, who was featured in that great film, that Hollywood blockbuster, The Big Short.
Big Short.
And you know, back in 2008, you know, he made some predictions that made everyone think that he was crazy, right? Difference was that actually, you know, he bet, you know, a lot of money on the fact that the market was going to collapse, and that it did. And he made his fund, you know, absolute billions of dollars, right? I mention him because he's doing exactly the same thing. You know, he's bet $1.3 trillion that we are going to see a market collapse, right? And so, look, he might be wrong, right? You know, there's no guarantee that anyone's right or anyone knows what's going on. But for me, the fact that, you know, he's got it right before, the fact that he's put so much wealth on the line, and is therefore not just merely a voice or a prediction that decides to change it every 6 months in line with the market, he's standing firm. And we see a lot of the hedge funds, family offices and investment banks follow suit with what Michael Berry predicts.
Yeah, smart money and the big guys, as we said earlier on. And you know, there's something there that Warren Buffett as well. I remember a couple of years ago, and I moved out of the market substantially from my family's pension and all. I was probably out a little early, but I remember thinking at the time, Warren Buffett's getting out to a large extent. And I sent out a tweet probably 2 years ago, and he was up to, wait for it, 100 billion in cash. And I was like, wow, or maybe it was 110. Wow. Now he's at 320 billion. I mean, like, so all around the smartest guys in the room, if you will, or gals, we won't be sexist, there's a lot of movement back to the sidelines. Yeah, I am really concerned with the market in the next 6 months.
You're right to bring that up. You know, a lot of people during times of uncertainty are keeping their powder dry, right? You know, there is the doom and gloom of, you know, recession brings, you know, the contraction of economies, and, you know, people lose money and they lose their houses, and, you know, they lose their retirement. Yes, a lot of those things are true, and that's really sad. But we also know, whether or not it's right or wrong, that the richer get richer. The rich get richer. And we know that actually there's a huge amount of opportunity during times of recession. We know that the market will dip. You know, if we believe the market's going to dip by 50%, then doesn't it make sense to kind of keep our powder dry, have enough liquidity to buy those equities when they're 50% cheaper, especially if you're looking at a longer term investment? And so there are two ways in which our clients see the market. And you know, we service professional investors like investment bankers, accountants and lawyers that don't need any guidance from us. They do what they do, and you know, they probably know more than us. And then we've got, you know, other investors that have never done this before, and they'll rely on our procedural and factual guidance in terms of how this works, and a bit of background to the market. And their view is, rather than keeping your powder dry in cash, whereby we know that we're losing money to inflation, at best, at worst, we're exposed to counterparty risk. which means that we're having to rely on a bank being able to give that money back to us when we need it, doesn't it make more sense to have your wealth in something that is physical, something that is tangible, something that has exactly the same status by the government as cash does in terms of liquidity, but the difference being is that physical gold is a hedge against inflation, which means that it should outperform inflation, and at the same time, as the markets drop in value, equities and bonds and property prices, the value of gold tends to increase. And so what you've got is, very worst case scenario, you want enough purchasing power to buy the same asset classes but for half the price. But if you can be in a position where actually the asset class that you've used to preserve your wealth has now increased by 50% because of its popularity during times of uncertainty, well, now you can buy not only twice the amount of asset class, you can buy, quadruple the amount of asset class because you've got double the amount of liquidity that you had before the market corrected itself.
And indeed, even at 3,000 now, 200, I guess, and some change, it did hit 3,500, but JP Morgan, no less, has suggested 6,000, and that'll move up and down. And also Goldman Sachs, I think, were bandying around figures like that. So it's not just the kind of hoarders and the doomers talking 5k gold or even much higher. Even top brass are saying it too, and they are not people that like to promote gold for the very reasons you said, because they don't make money. They make money out of paper stuff. So again, you don't want people going out the impression that, oh, gold will double. But it is feasible or possible it could. Now, that does remind me of one of the last questions, Josh. A correction in gold may be appropriate. So currently at 3.2, it came down from 3.5 in dollars. The best I hear from people like Simon Hunt or Piepenberg and a few more, and I haven't asked you yet, is it could correct as low as 25, 26, 2,700. But it may very well not. What do you think in terms of corrections outside of a big crash first? Just natural corrections.
I think we've got three scenarios. The first scenario is that it continues increasing, like it did between 2008 and 2012, like it did between 2022 until today. It's possible. The second scenario is that the world starts to get far more certain. Everyone starts to agree on peace, right? The market becomes a lot less volatile. Debt starts to decrease. Equities go up in value. Interest rates go up in value. We're getting a lot more for our savings in bank accounts. In that situation, you will see gold correct itself, right? Are we there yet? I don't think so. Will we be there? I hope we will, right? For the benefit of all of us, I hope we will be there at some point soon. The third situation isn't actually, it's not a situation that people give enough insight or value to. And it's this. Whenever we see, a recession, or whenever we see a kind of a big or unexpected fall in the value of equities, we can see gold drag down with it. And the reason for that is that gold is very liquid. By its nature, you can convert that into cash anywhere in the world into any currency almost instantly, right? And so it's viewed as cash. As the governments under Basel III, Tier 1, they see it exactly the same, which means that, if you're in a situation where you're losing money on equities, or you've lost money on property, or you need to kind of raise cash really quickly, for fear if you don't, you'll lose even more, well, the quickest and easiest thing to liquidate will always be your gold, right? You'll get your hands on your liquidity far quicker with your gold than you will do your equities or your fixed term bonds. And so what tends to happen there, and this happened back in, when COVID was announced, we saw the gold price dip by 12%. Everyone was thinking, that's weird, like uncertainty is high, equities are falling through the floor, people are pulling their hair out. Gold tends to increase in times of uncertainty, and that correlation wasn't presenting, right? But what was happening was that people that actually had gold were liquidating it in order to cover themselves in their other investments whereby they were losing money, right? So as quickly as that fell to 12%, we then saw institutional money, smart money, buy in the dip, take advantage, and the dip was very temporary. And so it increased, not only did it recover by 12%, it then increased considerably right up until today. And so, I see that personally as an opportunity, either to kind of buy for the first time or to cost dollar average. Being able to kind of phase in your purchases, knowing that there might be a bit of a pullback, take that as an opportunity to buy more to reduce the average cost that you purchased at the last time you bought.
Yeah, that's perfect. The old DCA, dollar cost average, and that's kind of, I can actually state truthfully, in the last few days, I moved another piece of pension into physical. And the thing on that very basis that, yes, okay, 3,500 came down to 32. I obviously bought originally at 16 or 17. But yeah, just moving in, it could correct again. It'll be an opportunity again. But always just building more and more for the long term. For me, it's really long term. It's for 10, 15 years. I hope myself, I'm quite a frugal guy, so I hope to leave some help to my 5 children, maybe, if we can assist them with stuff, But either way, compared to the equities markets, it's just securing what you do have. Silver we didn't mention, and I'm conscious last time we talked in London, maybe over a year ago, I forgot to mention silver. I kind of went with 30% silver, 70% physical gold. That's what I've heard from some people. Other people are now saying that silver has stayed suppressed and could slingshot upwards more than gold could, but that's kind of speculation. What do you think in the silver-gold ratio of what you would hold?
It's an interesting one. It's a question we're asked all the time. I think it depends on how long you plan to hold on to your precious metal, because silver is probably more volatile than gold in that it's much cheaper, which means that it only takes for a very small price adjustment to affect a larger percentage gain or loss, right? And so silver is regarded as gold's little brother. When gold goes up, silver tends to go up, and it does tend to outperform gold when gold increases. But the same is true when gold goes down, silver drops, and the swings are larger, right? So it might fall to a larger extent than gold does. That correlation is ironed out over time. And if we go back a few hundred years, the ratio between gold and silver has always been 12-1. It would take 12 ounces of silver to buy 1 ounce of gold. And that was the ratio between those two metals for a very, very long time. Gold then shot up in 2005, 2006, and the ratio between those two metals widened quite considerably, right? I think it peaked at around 120-1. Right now, it's at 100-1. And so I don't know any analyst that doesn't believe that silver isn't massively undervalued, right? It should be trading at around 5 times the amount it is at the moment. For me, this is why silver is really interesting. Yes, it presents, an investment case like physical gold in that it's physical, it sits outside the banking system, it's private, it provides tax advantages similar to physical gold, UK gold coins. It's an effective transfer of wealth between generations, between third parties. You can convert it into cash as easily as you can physical gold. You've got very similar markets for it. But it's the volatility over the short term that tend to scare people off. What I'm most interested in is, I think one of the very few things that the world can agree on is that as society advances, we're becoming greener and greener and greener. Or that is the kind of objective. Most people believe that in the next 10 to 15 years, cars will be completely electric, right? Having a petrol or a diesel car may well become a collector's item, right? It might be longer, it might be shorter, who knows? It might not happen to that extreme, but we're certainly heading in that way. Now, every electric car for every electric battery that a car requires, it needs 2 ounces of silver. Solar panels need silver. Nitrates and photography need silver. Medicines need silver. And so there's a huge amount of industrial demand for physical silver that's only increasing. Now, there's only so much silver you can get out of the ground. And actually, when you mine for silver, you can't actually, mining for silver is incidental, right? It's very, very difficult to actually try and find silver. You know, being able to get silver out of the ground is normally incidental of getting something else out of the ground, right? And so that at its best is purely speculative. And so if we accept that industrial demand for physical silver is considerably higher than the amount of it we can get out of the ground, and more people are purchasing it because they understand and appreciate the investment case of physical silver, you can see why so many analysts are referring to physical silver as potentially one of the most precious of the precious metals. You know, it's got a long way to go. It's very undervalued. But in the same way as I hear of lots of people saying, I wish I purchased gold in the 1980s when an ounce of gold was, you know, $25. And a lot of people say that silver is now at the same crossroads that gold was in back in the 1980s. Right?
Yeah.
And I think that's the interesting observation that a lot of the hedge funds and a lot of the banks are making. There's no coincidence that they're cornering the market, and you see the likes of JP Morgan purchasing hundreds of millions of dollars of physical silver periodically.
Yeah, that would make sense. And I still think those 70-30, because silver is more volatile and it's not the tier one, in fairness, with all that central bank BIS backing, and it's a little more speculative, but it could have a much bigger upside. I think having 30% kind of feels about right to me. Not that we should ever use feelings in these financial matters. It should always just be data, of course. You know what? I'm conscious of your time, Josh, but maybe I'll leave it open just for your final thoughts on the whole precious metal space versus the... So many people have financial advisors. I'm not sure you mentioned this already, but the financial advisors, the problem is that they get their cuts from selling instruments. They're inherently conflicted, even, you know, if they're good people and that they have your own interests at heart. How can they take away the conflict that they're just not in the business of advising gold at all? I mean, I know a few personally. And when I told them I was getting physical gold back in 19, literally they just quizzical looks. They just couldn't understand the concept. So yeah, what do you think of that? Financial advisors and just being careful to get a broader view.
So it's the system. It's the system in which we operate. And one hopes that we can disrupt that system and make a change to it. But you're right, there's this conflict. You know, financial advisors will make money on assets under management. And as I said before, you know, I don't believe there's been any financial advisor that will ring up a client and tell them to remove all their money from the stock market right before a crash or right in the middle of a crash, right? Nor would I expect that to happen because there's a conflict. And actually, you know, financial advisors are going to value their family probably more than their clients. And therefore, you know, telling all of their clients to come out of the market effectively reduces their fees to zero, right? They can't feed themselves. And so I can't see a scenario where that's going to change unless the system change. The other factor to take into account is insurance, right? The regulated market sometimes boils down to accountability, right? Passing the buck. Advisors don't want to suggest something in case someone turns around and says, you gave me the wrong advice, and they get sued and someone's making a claim on their professional indemnity insurance. And so every financial advisor needs to take out professional indemnity insurance. As a business, you want your insurance to be as low as possible. You also hope that you don't need to use that insurance, right? But whilst you're hoping not to use it, you want that to be as low as possible because, you know, the higher it is, the less money you make. If you decide to take out professional indemnity insurance against alternative asset classes like physical gold, what do we think that does to your professional indemnity insurance? It increases it. So if it increases their insurance and it's not something they've recommended before, it's going to be the first thing they leave off their insurance policy, which means that if they come into a situation where a client says to them, what do you think about physical gold? You know, I want to take some of my money out of the system. I want an asset class that's completely tax efficient, where I don't have to pay any tax on the gains that I make, similar to an ISA but with no restriction. And I want an effective transfer of wealth between me and my children if and when I pass away, right? Even if the advisor was fully aware that physical gold could provide all of those benefits, on a bad day, they couldn't advise it because they haven't got the insurance that allows them to say, I think you should do this. And so for me, it's the system. I think the system has to change in order for the advisors that sit within it to be comfortable advising on that product. You know, we're doing a lot of things at the moment whereby I hope we can make a difference. You know, we have IFAs that will talk about physical gold. They will advise on physical gold. And so it's a slow but sure process. And it's something that I hope to be able to report on in the coming kind of months or so.
Excellent. Well, I certainly look forward to that because, by God, the vast majority, as I say, I know of a few, and they literally are in the barbarous relic zone. I don't think they have any knowledge. They say, oh, well, it doesn't have interest, it doesn't grow. And it's like they've been kind of indoctrinated themselves, even beyond the insurance and the other issues. So great stuff, Josh. Really enjoyed this. Any last thoughts or?
Well, I would say my last thought is this. You know, no one holds a crystal ball. No one knows what the future holds. As I said before, we can predict that the market should correct itself because, you know, if we look at history, it's done that every 7 to 10 years and we are outside of that time period. So we can make those predictions. We can anticipate that we may well see black swan events. And in that scenario, I would say knowledge is power. You know, we provide a consultative approach whereby we like to inform investors as to, you know, what's available, you know, how does it work? You know, the mechanics of being able to purchase physical gold. Do they take delivery? Do they store it in a vault? Do they purchase within their pension? Do they remove exposure to equities and bonds and equities? Now, we're not financial advisors, so we can't tell someone that they should do any one of those things. All we can do is talk about what our customers are doing in this current present day. And like I said before, knowledge is power. You know, if your audience come onto our website and download our investor guide, they will find a wealth of information. They can also book an appointment with one of our consultants whereby they can ask whatever questions they need to ask about getting started or not getting started. It's not just about, you know, we want you to start today. We want our customers or potential customers to have enough information for them to feel comfortable getting started at some point. It might not be today, it might not be tomorrow, but I think with the continuation of the world and in the way in which it's going, there'll be a time where customers think maybe today's the day.
Yeah. If you're going to do anything, you got to begin it. There's all has to be a start. So great stuff, Josh. Thanks so much.
Thank you, Ivor. Take care.
That'll do it, folks. Hope you found that informative. And I'm also going to put a link down below to a video from Mike Maloney. A lot of respect for Mike. He's been in this game a long time. And it's just on the recent silver breakout. So maybe have a look at the short 10-minute video from Mike. Goes through a lot of graphs and a lot of detail, but makes it understandable to the layperson. And then, of course, consider heading over to the guys at Pure Gold UK. No financial advice, but they have a team of advisors who can help you understand more broadly what's going on and what moves one might make to secure one's family's pension, you know, savings and anything else really, and keep it outside the worthless toilet paper fiat currency world. Thank you.